All right, everybody. So in this video, we got to talk about Silicon Valley Bank. Now, this stock is plunging today. It basically fell like $160. So it was around like 265. Now it's around 106. So what exactly happened? So a lot of things happened. So earlier, this company basically got a downgrade. Now, let me just talk a little bit about this company. Now, as far as I understand, this is pretty much a company that lends to venture capital and private tech companies, and they rely heavily on the IPO market. Now, 2020 to 2021, we saw record amounts of IPOs. This was like over 1,000. So if you remember all those SPACs that came out and all those mergers with those blank check companies, all of that nonsense. And now, obviously, the aftermath of that is that we have all these zombie companies, and they're basically burning cash until they go bankrupt. So this is essentially the situation right now. And in 2022, we didn't have a whole lot of IPOs. So obviously, a company like Silicon Valley Bank, they're not going to do all that well. So what happened recently to pretty much cause this sell-off? So we did see a little bit of worry with their financial statements or just their financial health in general. And a lot of people are doing bank runs on Silicon Valley Bank. Now, we could talk about their pretty much their notes and bond situation. So they lost a significant amount of money investing in U.S. Treasuries. So let's just go through this. So they have the strategic actions Q1 2023 mid-quarter update. So this is from an 8K report, which is basically a report that reports significant events or material events, I should say. Now, if we're just going to scroll down a little bit, we see this sheet right here. It says strategic actions to reposition balance sheet for current rate environment. So right here, they have their AFS portfolio sale. So AFS stands for available for sale, and it's pretty much just an accounting term. So what does this mean? It means that when they purchase US debt securities or just any debt securities in general, they have the intention, management has the intention to not hold this to maturity. So let's say I go and I buy a 2-year note, okay? I'm going to go buy a 2-year note. And I could basically hold it until maturity, which is called held to maturity, or I could sell it before it actually matures. So if they plan to sell it before it actually matures, it's classified as AFS, which is available for sale. If they plan to hold that security until it matures, it's called held to maturity. So here, if we're just looking at their AFS portfolio, the sale size is $21 billion. So they're selling $21 billion worth of U.S. Treasury and agency securities, which have a time duration of 3.6 years. Now, look at what the rate is. The rate is 1.79%. So that's absolute trash. You have to think about what the 2-year is giving you right now. The 2-year is giving us like 5%. And you could literally get like 5% CDs. Bank savings interest rates, I don't know what they're giving you, like 4% now? But anyways, you could pretty much get much higher yield than this right now. So they were early on this. They bought early. And essentially what happened is that their money is tied up. They have $21 billion that's tied up, with a 3.6-year duration. And obviously the economy isn't doing too well. Their bread and butter, which is IPOs, that's not doing well either. And it doesn't look like it's going to do well in the foreseeable future either. So, this bank has literally landed themselves in a pile of shit. And now they're in the situation where they have to get rid of these United States Treasuries and agency securities. And they need to take a pretty hefty loss. So this preliminary estimated realized loss. So when you say realized loss, that means that they're selling it. Unrealized means that they're holding it. So now they're taking a $1.8 billion after-tax loss. And now here's the real shitty thing. Now they're trying to dilute investors to basically make up for this. So they have this capital offerings, and this is just their base size. So they're basically going to offer common stock of 1.25 billion. Now they're going to do a private placement of 500 million. And this is a commitment from General Atlantic to purchase their restricted common stock at a public offering price in a separate private deal. Now, they have mandatory convertible preferred stock of 500 million. So this is a pretty big offering size. It's like 2.25 billion. So, obviously not a good situation. Now, let's just go ahead and take a look at their balance sheet. So if I'm looking at their balance sheet, let me just scroll up a little bit. All right, right here. So if I'm looking at 2021 and 2022, we can see, oops, scroll down a little bit too much. So if I'm looking at 2021 and 2022 right here, and keep in mind that these numbers are in millions. So if I'm scrolling all the way down to their equity, we can see that total equity is 16.3 billion right here, but in 2021 it was 16.6 billion. So this number did go down, but I want to show you their prior years. So if we're looking at 2021 to 2020, here in 2020, let's go down to their equity. Their equity was 8.4 billion, and here in 2021, their equity was 16.6 billion. So their equity doubled. And this was pretty much the effect of all of these IPOs and, basically that IPO mania that we saw. So obviously, now things are looking a little bit stale, and, they are taking a loss from that investment that they made. Now, let me go down to the income statement. So if you go down to the income statement, you can basically see this sheet right here. It says consolidated statement of comprehensive income. So this is where we can see those unrealized holding gains or losses. So right here, if we're looking at changes in unrealized gains and losses on available for sale securities, we can see right here they have this unrealized holding gains and loss of $2.5 billion right there. So if we're looking in 2021, this amount was 644 million. In 2020, they were actually positive. So positive, negative, very negative. So this is almost like your average retail investor. They were making a ton of money, then they lost it all, then they lost like quadruple that. So yeah, they're not doing too well. And that's essentially the basis of why they're doing this offering. So yeah, they're doing the shitty offering to basically just cover their losses right here because they're incompetent. So yeah, obviously not a good, obviously not good management on their part. Now let me go over to page 49. And page 49 shows the sheet right here. It says average balances, yields, and rates paid for the year ended December 31st, 2022, 2021, and 2020. So right here, we could see they're available for sale securities and taxable. So taxable, I'm assuming is referring to United States Treasuries. So if we're just looking right here, their yield is like 1.59. So that's absolute trash. If you're just looking at what the yields are right now for like 2 years, like I said, it's about 5%. So yeah, 1.59 is not that great. If you're looking at their held to maturity securities, the taxable and non-taxable, I'm assuming they're referring to municipalities. So if we're just looking at this, the yield rates aren't that great either. You got 1.87 and you got 2.54. So obviously not that great. Now, if we're looking at that report that they gave us, right here, it says that it's 1.79. So this is the most recent. So obviously that's still not great either. So long story short, this company, they screwed up and now they're trying to get bailed out by the markets by doing this offering. So hope you guys enjoyed this video and have a good one.